Think about the card you just saw. If it was the Four of Diamonds, then you know you've been programmed. You know you're still living in the matrix. You're living in a world where 4% is high yield. 4% dividends are not high yield anymore. Companies like YieldMax, NEOS, Roundhill, Defiance ETFs, they're all coming out with products that pay 30%, 50%, 80%, even more in yield. Sometimes that's weekly income straight to your brokerage account. And you can live off that. You can be financially free, or you can supplement your job income. You can exceed your job income with some of these ETFs. Of course, they do carry risk, and we will talk about that. But this video is just financial information, financial education, not investment advice. But it's designed to let you know that you can be free, that you don't have to settle for 4%. Let's get into it. So let's take a look at some of these ETFs out there. Let's visit their web pages and see what is going on. We're not going to peek too far under the hood. We just want to get you started. Plant that seed, that idea that you don't have to settle for 4%. So let's start by looking at Defiance ETFs, QQQY, the NASDAQ 100 Enhanced Options 0-Day to Expiration Income ETF. The headline here is that 38.92% distribution rate, and these distributions are paid weekly, which for an ETF that tracks NASDAQ covered calls is pretty darn good in my book. So here's what it says. Aims to achieve consistent weekly distributions for investors with equity market exposure to the NASDAQ 100. Actively managed, seeks income. And if we look at the average annual performance since inception, not to be confused with the cumulative performance since inception, but the average annual, 13%. 13% is good. And we can see some more facts about the funds. They don't have a large market cap right now, just 180 million, but that has been growing. The expense ratio is high. It's going to be higher than ETFs like VOO or QQQ, which just track an index. That's because you're paying for that active management. And it's just got 9 holdings. And if you look at the holdings, you're looking at basically the options trades and the cash that they have to secure those options trades. So you have, NASDAQ puts, you've got treasury bills there, and then cash as well. This will look, you can click on here, but this will look more full when they start doing more trading next week. Next, from NEOS, we have a similar ETF, QQQI. It's got the 2025 Best New Active ETF award. I don't know what that, how meaningful that is, but okay. Distributions, monthly distribution rate, 14.56%. So this is an ETF that is tracking the NASDAQ, but it's also paying out distributions monthly, which is awesome. Expense ratio. This is actually a fairly low expense ratio for these kinds of covered called ETFs that use options. It's still 0.68% is high, but you'll see a lot of others have like 1, 1.2, 1.3%. So what this does is, firstly, it's an income ETF, but it also does hold the positions in the NASDAQ. And the nice thing about that is when they're writing their covered calls, they don't have to write calls on 100% of the portfolio. They could have, maybe 60% of the portfolio is non-covered or non-written, and 40% they'll write covered calls on those. So if the NASDAQ really goes up and those covered calls are exercised, they'll lose that 40% of the portfolio, or the gains from that, but they'll keep the rest of it. So they still get some of that capital appreciation and that upside with the distributions as well. Sorry if I didn't explain that well. I'll do it in another video. But you can look at the charts there, the distributions. Again, it is monthly. And if you look at their top 10 holdings, you'll see that they actually do hold the positions in the NASDAQ, and you can download it there as well. Also from NEOS is the S&P 500 one. Again, just going to be a similar strategy, but holding the S&P 500 stocks, similar expense ratio, lesser distribution rate because the S&P 500 is less volatile. But again, what they're doing is they're doing high monthly income. They invest in the S&P 500 and do call options. So to think about those call options, again, I'll try to explain it, but they will hold the stocks in the S&P 500. They'll write covered calls, maybe on all of them, maybe on some of them. And when the stocks go up but don't meet those calls, you still get the appreciation. When the stocks go up and shoot through the covered call ceiling, they won't get all that appreciation, but they will still get the option premium income. So it's kind of like a mixture of passive and active, a mixture of equity returns and monthly income. I really like these funds. And again, here are the distributions. 12% on something that is holding S&P 500 stocks, in my book, is good. Next up, I want to familiarize you guys with Roundhill Investments. You can look at the website yourself, but they've got things like the weekly pays, ETFs. These are similar, if you're familiar with YieldMax, to the single stock ETFs. You see Tesla, MicroStrategy. So this would be the equivalent of like a MISTI. I believe YieldMax has a Palantir one as well. But the weekly pays ones that are single stock covered calls there. But if you want something more broad, you could look at the NASDAQ 100, QDTE, which is also paying, well, I have it up on this tab, 34.92% distribution rate. This is going to be kind of in that similar range to what we saw from Defiance ETFs, covered call strategy on the NASDAQ 100. High expense ratio there of almost 1%. And then if you look at the holdings, you'll see a lot of calls there. Also from Roundhill is this one, kind of interesting if you're one of those Bitcoin crypto people. You've got YBTC, Bitcoin covered call strategy. It's kind of like, it's not like Coinbase, but YieldMax has one similar. Look at this distribution rate, 55.15%. Of course, Bitcoin is risky. Has wild swings going up and down a lot. Everyone knows that. So you should expect that this will still continue to be a volatile ETF, and ideally that volatility means your options premiums are still high. I think that's all I wanted to say there. AUM approaching 300 million. Lastly, SCHD. I don't want to be one of those people who say, okay, boomer, but this is kind of like the old guard of ETFs. This is, a dividend equity ETF that kind of, good dividend income. But when you compare it to these other alternatives like SPYI or QQQI, you're not getting as high of a dividend, but you are getting perhaps that stability, that large, AUM. So institutions probably like this. But individual investors should consider what their goals are when it comes to income. And I think there are better options than SCHD. Look at that, 3.87% distributions. Performance over the years, they're not going to show us over the years. Yeah, I guess, they'll show us 12%, not bad. You can also get that from, VOO or SPY as well. So just wanted to show you guys, there are more options out there when it comes to getting dividend income. You don't have to settle for 4%. If you want to and you want to play it safe, that's totally fine as well. But for those who want to go a little further out on the risk spectrum, get more weekly income, there are options out there. No pun intended. But all right, everyone, hope you enjoyed the video. We'll end it there. Thank you so much for watching, and see you in the next video.